Good afternoon, everybody, and a special welcome to our three panelists. Welcome to this presentation of the EPA Alumni Association Academy. Today, we're going to take a bit of a respite from events inside the Beltway that have preoccupied many of us. Today's session is the insurance industry and climate change. And we're fortunate to have a panel here to discuss this part of how this part of the private sector is coping with the impacts associated with a warming planet. While others have been confronting this issue for a while, my own introduction to the issue has parallels with this reputed story of Isaac Newton's interaction with a falling apple. In my case, the falling object was a tree branch, which luckily did not hit my head, but it did damage my fence. This led to a claim with my home insurance company, which led in time to cancellation of my policy because I wouldn't cut down all the trees on my property. It then struck me intellectually that the insurance industry is very much at the center of the economic effects of climate change. And I wondered what they're doing, other than losing customers. The issue was quite recently thrown into vivid light when a board member of one of the world's largest insurance companies stated that climate change could cause the financial sector to cease to function and capitalism cease to be viable. And those are his own words. To discuss this issue, we have today, first, Commissioner Andrew Mais, Insurance Commissioner for the state of Connecticut, and who, as you can see in his bio, has been a leader in recognizing the challenge presented by a changing climate. Second, Ethan Aumann is the Senior Director for Environmental Issues and Resiliency at the American Property Casualty Insurance Association, and he can give us an insider's look at how the industry is dealing with climate change. Third, Jaclyn de Medicci Bruneau is Director, Insurance for the Ceres Accelerator for Sustainable Capital Markets, which is, and I quote, a nonprofit advocacy organization working to accelerate the transition to a cleaner, more just and sustainable economy, working directly with regulators and industry on the financial aspects of climate risk. As usual for these presentations, please use the chat function to propose questions for the panelists, and there will be breakout sessions after the presentations are over. Commissioner Mais, if you will now take the electronic floor and lead off our discussion.
Good afternoon, all, and thank you, Bruce, for that gracious introduction. And I have to say, this clearly, if anybody's read the news, it's another one of those days. There's been an executive order targeting state attempts to address climate change. So this is a very important discussion for all of us, certainly for me, and I'm glad to be able to participate in this with my distinguished colleagues. Now, let me get one thing straight. I'm not a policymaker. I am an insurance regulator. And as a regulator, my role is to ensure that consumers have access to protection while we maintain a solvent and stable insurance market. And that is why climate risk is such a big concern. Climate risk is one of the most pressing challenges for our industry. It affects consumers. All you have to do is look at the newspapers over the past year or two or three. It affects businesses, and it affects the economy as a whole. I will tell you, I think it was late last year, I was on a panel at the IMF at their, the IMF World Bank annual meeting. And it was the first time they'd had an insurance panel on the main stage since Bretton Woods. And there was a reason for that. It was because of the impact of climate change on the entire economy and the concerns that we face. And this was an international panel. This is not a U.S. effort. On that panel, we had representatives from Africa and from Asia as well. This is a global issue. And it is a global issue because it will, as you mentioned, it has the ability to be one of the significant issues that will affect the availability and affordability of insurance for consumers anywhere. Insurance, as we know, is risk-based. And for us, a critical part of how we have to, or how we have chosen to address climate risk, is to help to build resilient communities. And certainly we've got many partners in this mission. You've got some, my colleagues here are among the partners that we've spoken to, that we've worked with. Certainly in my own state of Connecticut, we work with environmental experts. We work very closely with our state's Department of Energy and Environmental Protection. We work with builders. We work with financial organizations like our Green Bank, because this is not an issue that we as insurance regulators alone can solve. It is an issue that has to be addressed holistically because it is that significant and it is that difficult to deal with. Today, though, I'm going to focus on how climate change is reshaping the insurance landscape and what we as regulators are doing to address these challenges. And it's pretty obvious what's going on. Yeah, I mean, we can discuss reasons, but if you look at the frequency, the severity of the climate-related disasters, they are certainly increasing. One of the things that I unfortunately have become very familiar with on the NOAA website. NOAA has a list every year of the number of weather and climate disasters that cost over $1 billion, and this is adjusted for inflation. And the U.S. in 2023, we had a record 28. If you look at the numbers, if you look at that chart, it's a chart that just goes up. Now, Connecticut faces significant exposure to coastal storms and hurricanes. Here in our state, we've got $675 billion. We're a small state, but $675 billion of insured property is located just along our coastline. It's the seventh highest among the Atlantic states. And given our lower population, you can see that is a high per capita amount. It represents 64% of all insured property in Connecticut, ranking us third behind Florida and New York. And the rising risks are leading insurers to reevaluate their exposure. We are more fortunate than many other states, than a Florida or a California right now, or Louisiana, states that are fighting to ensure that insurance remains available. But the cost, even in Connecticut, is still going up. We've seen last year, actually not the last year for which we have numbers, which is 2023, the reinsurance costs here went up by about 60%. We've got carriers pulling out of high-risk areas. We've got carriers limiting new policies to reduce their risk. And we've seen a hardening property market that makes insurance less accessible and affordable. So what do? Certainly, insurers, we're all facing unprecedented pressures from climate-related claims. The rising cat losses are straining the underwriting models, and especially with, as I mentioned, the reinsurance costs increasing significantly, it affects insurers' financial strategies. Now, premiums are rising, coverage options are narrowing for consumers, deductibles are increasing. Insurers are doing their best to keep coverage going by being able to properly and accurately assess their risk. So they're using advanced cat modeling, AI-driven risk assessment to refine their exposure, which is great from a solvency perspective for me. The downside is that means that some people are going to see their premiums go up if nothing changes. And we need to make sure that consumers, especially, and I say this, which I shouldn't, but the really rich people in the big houses along the coast can probably afford to invest. The ones I'm concerned with are the people who are living paycheck to paycheck, who may have received their homes. It's been in their family for generations. They want to keep the homes. And the cost of insurance and the cost of insurance is increasing. The ability to get insurance is decreasing. So that's why we as regulators, in addition, in concert with people like my friends at APCIA and in the industry and others, think that investing in resilience programs to reduce future claims is a primary importance as a first step. We all know what the climate scientists will tell you as you're dealing with the risk. It's mitigation, adaptation, migration. Let's do as much as possible to ensure that consumers are doing the resiliency efforts. That's why, the NAIC's, the National Association of Insurance Commissioners, we've got the Climate and Resiliency Task Force, which continues to explore long-term regulatory solution, focusing on ensuring that risk remains insurable while maintaining affordability and accessibility for consumers. It is also why insurance is a business of trust. And if you buy something this year that, may not, the event that will trigger the payout won't happen 50 years into the future, you want to know that you're going to get paid then. So for us, and us as regulators in every state, including Connecticut, we're enhancing solvency oversight, and we are requiring insurers to incorporate climate risk into their resiliency planning. I don't think it's not an overstatement to say that the property insurance market is at a pivotal point. We need a collaboration among regulators, insurers, policymakers, academics, and consumers so that we can navigate these challenges effectively. Just looking at the time here, I think I'm getting close to out of time, but I'm going to say that we've been adopting solvency tools to address climate risk. For instance, our risk-based capital requirements now incorporate CAT modeling. We've got climate scenario analysis to help us anticipate future financial impacts, because we know that with increasing climate risk, past performance no longer guarantees future results. Just last year, we started the PCMI, Property Casualty Market Intelligence Data Call, to better track market trends, protection gaps, and that's a data call that covers probably about 85% of the premium dollars. It's all across the country. It is at zip code level, and the idea behind that is that it combines that vast big data so we can see emerging risks and start addressing them. And we can also take a look as insurance regulators, as state regulators, we can look down at the zip code level and see what's happening and see what we need to do there. It gives us the best of both worlds. In addition to that, we're encouraging, and a number of states have resiliency grant programs. Strength in Alabama was the first. And we ask companies to consider discounts for homes that are designated fortified through the Insurance Institute for Business and Home Safety. We know that a proactive approach to resilience is key to managing long-term risk. We can't reduce climate risk, but we can try to address it. Every dollar that we spend on mitigation saves, depending on which improvement you make and where, somewhere between $4 and $13 in future disaster recovery costs. Building fortification, improved codes, consumer education, all get together to reduce losses. And that's one of the reasons that here in Connecticut, in addition to the Connecticut Conference on Climate Change and Insurance in September, I started that 6 years ago when I started. But we've created a severe weather advisory council that has a multidisciplinary group of experts and academics, again, builders, insurance industry experts. We've got people from everywhere, because we need to encourage those stronger building codes. We need to figure out a way to effectively retrofit houses, and we need to create community-based solutions. I'm going to stop now because just looking at my clock, it seems I'm at the 4:15, and there's so much more I could say, but I want to pass it on. And it looks like Jaclyn will be next, and she has a great organization. Or Ethan, I'm not quite sure which. You're both on my screen now. But, certainly we've interacted with both organizations, and this is something that's top of mind for both.
Before I do that, as I mentioned before, I'd like to give Ethan and Jaclyn an opportunity to add to what you just said, Mr. Commissioner, in terms of before we then turn it over to Ethan. Jaclyn or Ethan, do you have anything you want to add to what was just said?
I think I would, first of all, thank you for the presentation, Commissioner. I think we would echo a lot of the messages that you just articulated so well and without slides. And in fact, I'll probably be covering or touching on some of the similar topics in my PowerPoint slides coming up.
Jaclyn, anything?
Yes, I would just boost Commissioner Mais's message on the great work that has been done at the NAIC level and at the state level. Connecticut and some other states have been at the forefront of this. So a lot of really amazing and important work to move this forward has been accomplished just in the last few years, and we definitely appreciate that. I would agree with everything he said, and I too will touch in some way or another on many of the things that he mentioned.
Okay. Ethan, I'll let you take the floor now.
Sounds good. Thank you very much. I'm just going to pull up my PowerPoint slides really briefly here. Okay. Trust that you can all see those.
Yes, we're seeing them.
Great. I'll just go ahead and jump in then. So yeah, I just want to thank you for the opportunity to join you today. I'm Ethan Aumann with APCIA. I'm going to spend a little bit of time talking about the property insurance market as a whole and then dive into some specific climate-related topics. And as I mentioned, you'll probably hear a lot of similar messages that Commissioner Mais just touched on. But to get started, just a little bit of background over the next couple of slides. APCIA is the largest property casualty trade association in the US, representing about 2/3 of the home, auto, and business insurance industry. And property casualty is one of the most competitive sectors with about 3,000 insurance companies. And so, as I'm sure you know, the basic function of insurance is just to pool and distribute risk. Property insurance operates largely as a pass-through mechanism, with the overwhelming majority of premium dollars that are collected being used to then pay claims. So with so many attention-grabbing headlines about insurance recently, including congressional investigations, you may be under the impression that climate change is solely to blame for troubled property insurance markets. And I don't want to downplay the role that climate change is having on losses, but there are also several other factors that we're seeing that are contributing to these rising losses and the insurance market disruption that we've seen in some catastrophe-prone states. And in fact, recent reforms that are addressing legal system abuse and some regulatory hurdles in some of these challenged states are beginning to really bring some stability back to the insurance markets. So in the rest of my presentation, I'm going to add some nuance to these media's narrative, the media's narratives about climate change and insurance, and then also offer some solutions about increasing frequency and severity of natural disasters. So before we get there, I just want to paint a really brief picture of what the property insurance market looks like as a whole right now. In 2022, independent ratings agency AM Best, for the first time ever, downgraded from stable to negative the entire personal lines insurance sector, and this is made up of home and auto insurers. AM Best warned that the personal lines industry lost tens of billions of dollars in each of the last 3 years, including 5 years of consecutive underwriting losses for homeowners insurers. So last December, personal auto was actually upgraded to stable, although that likely did not factor in the possibility of large auto tariffs that may increase claims costs. But the homeowner's outlook still remains negative. And so at the heart of this issue, property insurance companies are losing money, and the markets are under strain because of rapidly escalating losses and rates in some cases that have not kept up with those losses. So last year, the NAIC released a report on insurance profitability, with 2022 being the most recent year of data that's available. The red columns here are for auto insurance. The yellow columns are homeowners insurance, which had an underwriting loss and an overall small profit on net worth. And if you contrast these with the green columns, these are for the all businesses sector, which had a return on net worth of over 17% in 2022 and an average of nearly 15% over the last decade. So the question is, if you were an investor, would you invest money in home or auto insurance? And the answer is probably not. Contracting investment capital and large losses are causing insurance carriers to pull back from some markets. So this graph shows that increase in global insured natural catastrophe losses that I'm sure you've all had some exposure to or familiarity with. These losses have roughly doubled over the last decade. Primary perils, which are shown in the light green, are considered relatively low frequency, high severity events such as hurricane and earthquake, and secondary perils are shown in the darker green. These include more frequent, lower severity events such as severe convective storms, floods, and wildfire. And so what we're seeing is that those perils are now actually contributing an increasing share of overall losses. So with rising losses and record high global temperatures, how do we explain to our stakeholders that climate is not the only factor that's causing the losses to go up? Well, we point to several studies by risk analytics firm Verisk, global reinsurer Swiss Re, and others that have studied this issue in a lot of detail. And their findings highlight that property insurance losses are really being driven by four main causes. A major driver is higher exposure values and replacement costs. So in other words, more expensive buildings in riskier areas. Other factors are natural variability and weather patterns, climate change, and other man-made factors such as legal system abuse and regulatory mandates and costs. Since that last number 4 item is really off topic, I'm not going to discuss those issues today. That could easily be another presentation, but I'm going to touch on some of the others. So if we first look at rising prices, on this side you'll see the dotted lines on the left graph. These reflect the rapid surge in home values and construction costs that occurred since the pandemic. And the blue line is the consumer price index, and then the solid yellow line shows the increase in homeowners insurance premiums. Two things to point out really quickly here. One, and that is that homeowners insurance is a lagging indicator. It takes time for insurance companies to document inflation, file for rate increases, and then roll those new rates out to consumers over a period of 6 to 12 months. So insurance rates have really been paying catch up to overall higher costs there. The second thing I wanted to highlight was just that while housing and construction costs have gone up very dramatically, the premiums insurers collect to pay claims has really not kept pace. And then the right graph on this slide here shows the cost to replace all properties in the US. And this value has more than doubled over the last decade. Again, underscoring that a primary cost factor in property insurance losses are these higher rebuilding costs. Insurance costs a lot more because rebuilding inflation is making properties more expensive to repair and replace. So in addition to higher costs associated with repairing and replacing homes, the US has also seen an overall migration into rather than away from riskier areas. The left graph on this slide shows net inflows into counties with high flood, fire, and heat risk. And this is a trend that just accelerated during the pandemic. And then in the right graph, this is showing the percentage of new homes built in areas with elevated fire risk. So these are now making up a majority of new developments. And according to the same study in my state of Colorado here, roughly 90% of new homes built today face fire risk. So if we keep building the same types of homes in these disaster-prone areas, we can expect that insured losses are going to continue to rise. So I'll touch on now population and migration trends. The US population grew from around 250 million in 1990 to over 340 million in 2023. And as I mentioned in the previous slide, the growth has not all been spatially uniform. We're seeing greater population growth in higher risk areas and those areas with increasing exposure to various perils. So if you take Florida, for example, a state with extreme hurricane and flood exposure, its population nearly doubled since 1990. And Texas, as another example, between just 2012 and 2022, its population rose by 4 million people. That's the most growth of any state by far, and it's also led the country in extreme weather, logging 117 weather disasters costing $1 billion or more since 2011. Population increases in urban areas have also resulted in an expansion of the urban and suburban footprint. So today, more than ever, a storm that passes through many metropolitan areas has a greater likelihood of hitting insured assets. And this is something that's been referred to as the bullseye effect. The graphic on this slide shows the extent of the Denver urban area in 1990, and that's shown in light gray, and then in 2023 as a darker overlay. And then also the area impacted by a hailstorm that rolled through in May of 2024, with the storm's extent being shown in the colored areas. So the storm's main footprint was located in Denver's northeastern suburbs, and this is an area that's had a lot of growth over the past several decades. So the area that would have been hit potentially by hail larger than 2 inches from this storm expanded from 30 square miles to 72 square miles since 1990. Attribution studies are now increasingly performed to help answer questions about the influence of climate change on disaster events. And this Venn diagram shows the individual and shared vulnerability factors that contributed to losses from 3 different disasters in 2024. Hurricane Milton in the US, Hurricane Gaimi in the Philippines, and then Valencia flooding in Spain. So while climate change played a significant role in each of these events, there are many additional man-made factors that also contributed to overall damage, such as deforestation, urbanization, problems with warning and evacuation procedures. So I'm just highlighting those as also issues that need to be considered in our disaster mitigation efforts. A couple of slides here about climate attribution. So severe convective storms, such as thunderstorms, hail, and tornadoes, these have increased at roughly 8% annually since 2008. This graph breaks out the specific factors that have led to this increase in storm losses. And so of that 8%, you see that about 2.2% is due to inflation, an additional 1.2% from additional inflation due to rebuilding materials and labor, 2.3% from increased economic growth and the expansion of urban areas I just discussed. They attribute about 1% to climate change, and then 1.3% is attributed to other factors, legal system abuse, regulatory challenges, and things of that sort. So researchers expect this overall growth trend to continue, but they say that the impact of climate may become more pronounced over time. Swiss Re also modeled the expected hurricane losses for Florida in the 1970s, which is shown in light gray, versus today, which is in the darker gray here, and then pulled out the contributions of climate change, population growth, and building codes, and how those have factored into the projected change in storm impacts. So what you're seeing here is that the increase in hurricane activity, which was driven primarily by climate change, it's about 20 to 25% over this period of time. Demographic changes contributed a very large increase in exposures, but then improved building codes, which are among the strongest in the country in Florida, have helped to offset some of those increased costs of climate and population growth. So the good news, and I just have a few slides here to wrap up with, is that we have proactive steps that we can take to address these growing insurance losses and rising premiums that are happening in the face of climate change. And as an organization, we spend a lot of time advocating for accurate risk-based pricing, which sends those appropriate risk signals to the market about development in high-risk areas. The insurance industry is also engaged at state and federal levels to gain support for stronger mitigation and resiliency, for infrastructure improvements, the use of nature-based solutions, stronger building codes, and better land use policies to help prevent development in some of the most vulnerable areas. And we're also working with governments, leaders, regulators, and builders in securing adoption of those standards to help protect lives and make insurance more affordable and available in the long term. Commissioner Mais touched on this. Retrofitting buildings and adopting new building codes have been shown to be very cost-effective ways of avoiding damage from future disasters. And property casualty insurers also fund something called the Insurance Institute for Business and Home Safety, or IBHS. And this organization has developed fortified building standards and recently standards for wildfire safety. So fortified homes are designed to withstand hurricane force winds, and many of the upgrades that are part of these standards involve very low-cost refinements, low-cost straps and anchors that add additional strength to the structure. The wildfire prepared home and new wildfire prepared neighborhood programs have shown to meaningfully reduce the chance of home ignition. And these include measures such as creating a 5-foot defensible space around a home's perimeter. As Commissioner Mais also mentioned, some states have established grant programs to help homeowners upgrade their homes to meet these and similar types of standards. So we know how to build strong and safe homes through the work of IBHS and other organizations. And with some of these disasters, we actually see the value of resilience in communities that are almost entirely devastated, except for some homes that are built to the latest safety standards. And a couple of the communities in Florida, Babcock Ranch, another one called Hunters Point, were recently highlighted because they survived Hurricanes Ian and Milton with very little damage. Finally, this slide just touches on some policy priorities to better empower consumers and communities to help them understand and reduce and manage their risk. This include ideas like greater risk disclosure during real estate transactions and the importance of ongoing mitigation to reduce the likelihood and severity of a possible loss. Insurers also provide catastrophe deductibles in many states, and so to reduce insurance premiums, consumers can increase their share of the risk by selecting a higher deductible. Another popular idea that is yet to gain a whole ton of traction is the idea of a kind of a tax-advantaged catastrophe savings account, which could be similar to a health savings account for health insurance. This would allow consumers to better finance mitigation work and cover insurance deductibles. So that's it. Thank you very much. I know I probably went over my time a little bit, but I appreciate that.
Okay, thank you. So I will do what I did before. Commissioner or Jaclyn, do you have anything to add to what you just heard?
I'm not sure there is much that I would add, but I do have to tell you, because as I watched that, I saw that the Aumann 2025 CAT report, which I dip into frequently, and it does say, and it does indicate the things that we need to do. Inflation is a concern. I'm not necessarily sure we can address that. That will continue. Not sure there is anything we can do about that given the current economic conditions. I actually expect that to increase. But we have to focus on the levers we can pull. And that the idea of mitigation, but also that societal responsibility. I think the Aumann report pointed out that whereas we may think it's only the hurricanes that are causing damage, you look at severe convective storms, and that can happen anywhere. Those are the ones that are really driving the losses. And yet, as Ethan mentioned, we have more people moving into those locations, more people now than ever. So we have a more vulnerable population. We have an increased exposure. We have to figure out a way to mitigate that. We have to, we can't stop people from moving, but we have to work together to try to get them to move into locations that are best equipped to handle these disasters. I mean, if you've seen those, IBHS has a number of videos, but also just on the news. I remember looking at one in Florida after a hurricane a couple of years ago, where there was one house standing completely unscathed. It had been built to IBHS standards, and it was great. Similar thing happened in California in the wildfires. The person actually had cleared around it for a different reason, but the house escaped the wildfire because of that. The downside there is that is one property. We need to make sure there is community action, because one property surviving is great for that one person. Even if you've lost a community around you, what we want to do is to ensure that the community has a chance to survive. And whatever the size of the community, all the way it trickles. I was going to say trickles down, trickles up all the way through the state economy and through the federal economy. So that's what we should be focusing on. That's certainly why we at the NAIC last year, when I was president of the NAIC, we came out with our climate risk and resiliency structure, which was the first time we'd ever done it. And it was led by two states, Alaska and California. one a very red state, one a very blue state. But what it said to everybody is that climate risk should not be a political issue. It affects all communities, regardless your geography, your demographics, your politics. So it should be addressed by all communities. And that's what we're trying to do as regulators. We're trying to take the politics out of this and work certainly with all our partners as best we can to protect consumers. Sorry to go on here, but I get really passionate on this because to me it's just so important.
Jaclyn, you have anything to add?
Yeah, I would just highlight the importance of the information that Ethan just provided. You know, it really demonstrates the complexity of these issues and all the different factors that go into, you know, insurance pricing. And there's really no one easy fix. So I think that's important to note. A lot of people outside of the industry, you know, aren't aware of all these other factors that are at play, and why it's not such. There's no simple solution to everything that's happening in the industry right now.
Okay, before I turn it over to you, Jaclyn, I'm going to make an observation. This is out of order, but I'm going to make it anyway. I can feel the alumni watching this asking themselves a big question, which is, yes, resiliency and mitigation are fine strategies. Everybody will support that. But really, is that enough? So I'm going to elaborate on that comment after you're finished. Take it away, Jack.
All right. Thank you, Bruce. And actually, I'm going to discuss that very thing. A good 10 different measures that we feel the industry as a whole can undertake to move forward through these new climate realities. But hello, everyone. Thank you for having me today. I'm Jaclyn de Medicci Bruneau, and I'm the Director of Insurance for Ceres. And I'm actually a former longtime insurance regulator myself on the property and casualty side of things. And I've worked on the industry side as well, doing personal lines, product management in high-risk wildfire states. Next slide, please. So as we've really just heard from my very fellow distinguished panelists, the insurance industry is without a doubt facing significant climate-related challenges. And what I'd really like to emphasize is that it's not just an insurance industry issue, and Commissioner Mais had kind of touched on this as well. Insurance touches every aspect of our economy from the micro to the macro level. And the industry does face those three major interconnected challenges: the skyrocketing premiums, and as you know, it's not strictly due to inflation or market cycles, but major impact is deriving directly from those increased frequency and severity of severe weather disasters. And that's what's forcing insurers to reassess and reprice the risk. We're seeing those unprecedented market withdrawals as insurers pull out of geographic areas that they deem too high risk to provide coverage. And again, just to reiterate a point previously made, it's not solely the states that we would expect to see, like your California or your Florida, but inland Midwestern states are experiencing this as well. Kentucky, Oklahoma, Illinois, and that is due to those the frequency and severity of those severe convective storms, which is driving that. And third, just the overall general concern about whether the insurance market, both the industry and policyholders side, can weather this storm financially. The traditional risk models that insurance is built on were not built for this new climate reality. And that tension between market stability and accurate risk pricing just continues to grow. But what happens when these insurance challenges spread beyond the industry itself? The consequences of insurance market disruption, it really extends far beyond just the industry or that sector. And what we're seeing is that interconnected web of impacts that starts with insurance and radiates outward. So if we just take that kind of first layer look at the center of the housing ecosystem, you see significant shifts in the insurance market. The system-wide impacts that are driving immediate housing market disruptions with less affordable or available insurance. They reduce mortgage availability. That leads to increased housing costs, growing limited property sales, and contributing to overall market stagnation in some areas. And that in turn drives declining property values and creates a concerning cycle where you have lower property values, which leads to that reduced tax base, which in turn can decrease overall investment in those communities. So, and that's just a high level overview of how that cascading effect starts to kick in. So understanding these interconnections is critical, as we're not just dealing with individual insurance requirements, but navigating that web of market forces that affect everything from property to community level. Next slide, please, Beth. So if we talk about the broader societal impacts, when insurance becomes unaffordable or unavailable, again, it creates that cascade effect that disproportionately impacts vulnerable communities, but ultimately it impacts everybody. And we're seeing this play out in real time in many states. And, you know, the impacts of climate risk are not just an industry corporate problem, but a societal challenge that affects everything about our current way of life as we know it, honestly. So this slide actually really illustrates how insurance market instability ripples through the entire economic system. If we think of insurance as kind of that foundational piece of the modern economy, when that foundation becomes unstable, everything above it starts to wobble. So we have banks, real estate markets, local governments, businesses large and small, and across all sectors. They all depend on a functioning insurance market to operate. So when insurers start pulling out of markets or dramatically raising rates, it doesn't affect just individual policyholders, but again, creates that domino effect across sectors. And that interconnectedness is why insurance industry stability is so crucial to the broader transition to a climate resilient economy. Next slide, please, Beth. So these challenges clearly demonstrate that the traditional insurance framework requires a paradigm shift. So, you had just asked that, Bruce. Actually, last fall, Ceres developed a 10-point plan for the insurance industry. And here we designed a framework to address both immediate market stability concerns and long-term industry and community sustainability. So what's become equally clear is that no single stakeholder can solve this alone. It is not the fault of insurers, it's not the fault of regulators, and it's not the burden of just insurers or just regulators to address this issue. And that's why our plan really focuses on that collaborative approach. Each recommendation in our plan requires regulators, insurers, and all other stakeholders like local governments, community groups, and investors to work together. And it's really only through that kind of coordinated effort that we can create those systemic changes needed to move the industry forward. So I'll briefly walk through each point. Not all of them, but at the beginning, we have supporting mandatory climate risk disclosure. And mandatory climate disclosure addresses the information gap in climate risk assessments. So we do have, in 2022, the NAIC adopted, it's called the TCFD framework, and instituted the Climate Risk Disclosure Survey. And that's exactly what this does. And it's been fantastic. Actually, Ceres, we do the analysis of all of the surveys submitted. But last year, at the last reporting cycle, I think it was only 27 states and jurisdictions participated. So we'd like to see that increase, obviously, to all 50 states and plus jurisdictions. And currently, it only captures larger insurers. So we'd like to see it expand to include all insurers, regardless of size. Utilizing predictive climate modeling and AI integration, that would tackle that backward-looking nature of traditional insurance models. Historical data, which is the foundational premise that insurance is built on, it's just really no longer a reliable predictor of future risks. So advanced modeling would help insurers better anticipate emerging threats and develop more accurate pricing. Supporting innovative insurance products, and this is a big one. And we've seen a lot of great headway made in this area. So that would address coverage gaps by encouraging the development of new types of policies better suited to climate realities. This includes things like parametric insurance. If and I'm happy to dig deeper into that in our discussion upcoming. Community-based coverage models and products that incentivize resilience. Fourth, we do have incentivizing climate mitigation efforts. It's huge. Both Commissioner Mais and Ethan touched on that because doing home hardening projects and at the community level to reduce losses from the outset will help drive down costs over time, other external factors notwithstanding, but it'll just help overall improve resiliency. Incorporating climate-adjusted pricing models that would address both affordability and risk signaling challenges. Better pricing models can more accurately reflect risk while implementing gradual transitions to avoid those market shocks. Implementing mandatory and transparent climate transition plans. These would address insurers' own contributions to climate change through their investments and underwriting activities, as well as internal operations. Requiring transition planning to ensure the industry itself is aligned with climate goals is imperative. And this kind of flows from the climate risk disclosure, where carriers can quantify, assess, and describe how they manage climate risk as part of their overall risk management operations. And I believe both Ethan and Commissioner Mais had touched on updating building codes to be more climate resilient. We really need to target the vulnerability of our built environment. Building codes are such a patchwork, across state level, but at the local, the city, the county, they're kind of all over the map, so to speak. And they're quite outdated in many, many areas across the nation. Stronger codes would help reduce losses, improve insurability, and create longer-term community resilience as well. Fostering equity and accessibility measures that would address the disproportionate impacts we see on vulnerable communities who often face the greatest climate risks with the least resources. This would ensure that insurance solutions don't worsen existing inequities. And finally, leveraging insurers as investors. If we utilize insurers' massive investment portfolios to drive climate solutions, insurers hold over $30 trillion in global assets, and quite a chunk of that is in fossil fuel industries. But insurers can leverage that and significantly reduce capital flows away from fossil fuel industry activities and towards resilient infrastructure and clean energy projects. Next slide, please. So our plan, it really emphasizes three critical aspects. First, industry transformation, moving from traditional backward-looking risk assessment to proactive climate action. That includes incorporating forward-looking climate science, supporting innovative products, and incentivizing climate mitigation efforts. Secondly, that collaborative approach that engages insurers, regulators, policymakers, and communities. Climate risk is a systemic challenge that no single stakeholder can address alone. And third, that dual focus on maintaining insurance availability and affordability while simultaneously building societal resilience. We need both immediate solutions to coverage gaps and long-term investments in adaptation. So the insurance challenges we face are substantial, but they also present an opportunity to rethink how we approach climate risks across the economy. By transforming the insurance industry, we can create powerful incentives for adaptation and mitigation that protect both vulnerable communities and our financial systems. And as former EPA professionals, you understand better than most the importance of addressing environmental challenges through systemic multi-stakeholder approaches. So I hope this mini presentation has helped kind of connect the climate risks that you're familiar with to the specific mechanisms of the insurance market. There are so many different directions and deep dives we can take. So with that, I'll cede the floor back and I welcome questions.
Okay, I'll give Commissioner Mais and Ethan Aumann a chance to make some additional comments, but I would very much like to have a little time to ask some questions from the perspective of former environmental regulators.
Well, one thing I want to point out is that we are, as Jaclyn mentioned, we are doing an awful lot of what as suggested in that report. Everything from, predictive modeling, for instance. Certainly, and I will speak for Connecticut, but you'll see this everywhere. Actually, I'm going to not just speak for Connecticut, I'm going to speak for Connecticut and the NAIC. At the NAIC, we have a think tank, the Center for Insurance Policy and Research, and we created a center of excellence a couple of years ago to be able to analyze these models to make sure that they work. I mean, all models are wrong. Some models are useful. We want to make sure the models that companies are using are useful. Certainly in Connecticut, we've hired data scientists, and we're establishing a predictive modeling database and library so we can go through these. We understand, certainly as regulators, we've seen the market being distorted by people who unwittingly do not realize how much the changes affect the risk. We need to make sure that doesn't happen again, because that will not just mean that insurance is unaffordable. It will mean that it is unavailable. We need to do that, which is also why we do whether we're working on building codes or investing, we do as much as we can together, because this is not, to go back to what I said earlier, it's not just an insurance issue, it's a societal issue that we do need to address holistically.
Ethan, did you want to add anything at
I
this
would
point?
just echo again that highlight the importance of collaboration and coordination. I think both Commissioner Mais and Jaclyn touched on those topics, and we wholeheartly agree. So happy to answer some of the questions that our audience may have.
I'm going to throw one out here, and I'm going to push you a little bit. And if you don't want to be pushed, just let me know. But I think the statement, I forget the gentleman's name, but he's former CEO and he's a current board chairman or board member of one of the largest property insurance companies in the world, I understand. He said that as climate change progresses, we may reach a point where not just the insurance industry, but capitalism itself is at risk. From the standpoint of those who are looking at the climate science, I think it would be fair to say that we ain't seen nothing yet compared to what will happen if the global temperature average continues to rise the way it is. Now, I heard the things you're doing, and I think they're all important and they're all helpful. But that industry figure felt more is needed. That resiliency can get overwhelmed by this problem to the point where it fails. And so my question, to the extent you want to answer it, is what more can the insurance industry do to educate the public and to speak to regulators, perhaps not publicly, but perhaps quietly, and to do other things to confront this problem in a situation where now hear that maybe the coal industry should be revived, which I don't think will happen, but it's kind of a scary thought. So,
all right, I'll take a quick jump here just to spare everybody else for now. But my response would be that is presuming that we do not discuss this amongst ourselves, which we do. We are well aware of the issues. We are well aware of the concerns. And when I say that it is not just on the insurance industry, that means what I'm saying is that society as a whole has to respond. Certainly in my own state, which, again, we'll see what happens. I know my governor is quite willing to fight for this one. We have taken significant steps in order to reduce the use of fossil fuels. We have this is not this part is not financial. If you are going to stop or lower the rate of increase of greenhouse gases, you got to stop generating them. And that's not necessarily something the insurance industry in and of itself can do. And I know there are some things that the industry can do, but by and large, this is something that our legislators have to do. And as you mentioned, where you're looking at increasing the use of coal, which is completely counterproductive. And, just like if we don't have the data from NOAA that shows us what's going on, what are we going to do? How are we going to make accurate decisions? There are things that we would like to see, and there are things that we speak about both amongst ourselves with our legislators. That we, at this point, we are sitting, and certainly I will speak for myself. I'm sitting and hoping that the message gets through sooner rather than later, because I think this is a solution, or this is an issue that we as a society have to address.
Thank you. Ethan or Jaclyn? Come on, take a risk.
That's a tough one. And
This is all about risk, right? This is all about risk.
That was a great answer. I mean, I'd just say that to highlight Commissioner Mays' point, I mean, insurers are very concerned about climate and increasing disaster risk and frequency, and are spending a lot of time and resources thinking about these topics and projecting out future losses and scenarios. So, there is only so much the industry can do. But at the same time, I mean, it's an industry that is helping to support the development of renewable energy projects and new types of energy systems and infrastructure that's needed, along with the resiliency piece to help protect against the coming future disasters. So it's a multifaceted, really complex problem, and I think the industry is ready and willing and actively kind of cooperating and working with the relevant stakeholders in that way to do what they can.
And I would definitely build on that, and like Commissioner Mays had mentioned, everything in the 10-point plan, these are not, they're not new, right? These are things that have been ongoing and part of the conversation with different stakeholders for a while now, and they're in various stages. So the industry, both on the regulator side and the industry side, there's a tremendous amount of work and conversation and movement forward in how to appropriately address this. And it's not just the risk of climate risk either for the industry. There is tremendous opportunity for the insurance industry in pivoting to address what's driving, climate risk. I forget the report it was in, but there's something like $10 trillion of opportunity out there for the industry in, new innovative products or underwriting clean energy initiatives or things like that. So I don't want to give the impression that it's not already heavily ongoing on both sides, and a lot of work is being done every day by people a lot smarter than me on this very issue. So it's not something that's a side conversation per se. It's very much at the forefront.
Do any of you see the more industry leaders speaking out the way that gentleman just recently did in a very dramatic way? And I'll put that in two parts. First, as Commissioner Mays has said a couple of times, data from organizations like NOAA are very important to a lot of people, including people in the insurance industry. That's in the short term. And then the long-term risks are really quite staggering. So do you think there'll be more outspoken comment?
I'm going to defer to my industry colleague on this one because I'm glad to be able to hand that one off to Ethan.
Yeah. Let's see. Well, I think we're all kind of in a bit of a state of uncertainty right now. We've heard the same rumors about possible elimination of FEMA or federal data sources and things going away. And I think the industry is concerned about possibly losing access to some very important resources and data sources that they rely on to be able to make the types of projections and rate making and their modeling capabilities and things. And so I think it's kind of a little bit of a wait and see moment right now. We certainly think that organizations like FEMA provide important roles with disaster response and recovery, both in providing immediate assistance to communities that are impacted by catastrophic events, but then also helping prepare communities for possible future disasters. And FEMA also administers the National Flood Insurance Program. So, I mean, that is a critical kind of safety net there that a lot of, millions of Americans rely on for flood insurance coverage. So, there's just a certain amount of uncertainty right now, and we certainly support the preservation of some of those valuable and important resources and federal funding sources that help our communities just be stronger and be able to survive these types of disasters. It's probably a half answer there. Sorry, I didn't go too much further.
But you can only wait so long. I want to go back quickly to something I mentioned in my opening, which is one of the things that causes damages to damaged property are trees. On the other hand, trees are a big part of climate mitigation. So how do you balance reducing risk to structures caused by trees with the fact that we actually need more trees?
I can take a little shot at that. I mean, part of this is a matter of where the trees are and the potential risk they could pose to structures or vehicles and insured assets. I think we would agree that trees provide a lot of valuable resources for stabilization of hillsides and landscapes to help prevent earth movement and landslides when high precipitation events come through, and there are other ecosystem benefits that they offer. So I think it's a matter of kind of balancing where and how they're used and where they're placed. I think if it is a potential threat to a structure, then that becomes a bigger issue that that particular tree may not be in its the most desirable location.
Okay, I'm going to run through the chat. Anybody else from the EPA Alumni Association? Beth or David, do you want to have anything to add? No? Okay. So I want to thank the panel. I think this was extremely valuable discussion. I mean, we are not insurance people in this audience, so it's very interesting to hear how your industry is responding and what some of those solutions might be, at least in the shorter term. And I really appreciate the time you have spent with us today. I want to remind the folks listening in from the Alumni Association that Chuck will be organizing breakout sessions after this panel. So thank you all again.
Bruce, Dave here. Sorry, I was too slow on the unmute button, but I'll just add my thanks to all three of the panelists. We as a group need to get as educated as we can on all of these matters. And our slogan is, we're not done yet. So you give us more ammunition to go out and deal with these tough issues. So thank you very much.